Donald Trump's economic strategy sends shockwaves around the world. The U.S. president faces blowback for a trade war that some experts think will lead to a recession. But there's at least one favorable metric released on Wednesday. Owen Fairclough reports.
In a week when Donald Trump's trade wars have been blamed for raising fears of a recession here in the U.S., the president has at least caught a break on inflation. Prices increased 2.8% on an annual basis in February, lower than January's 3% jump. But egg prices jumping more than 10% due to the avian flu outbreak are a reminder that inflation persists in some parts of the economy.
And joining us now to talk more about the state of the U.S. economy is Edward Yardeni. He's president of Yardeni Research. Edward, welcome to the show. Great having you.
Thank you.
And after the 2.8% yearly inflation figure, right, how would you describe the current state of the U.S. economy?
Well, right now it's really quite resilient, but economists left and right are increasing their odds of a recession. We did that last week. We went from 20% to 35%. I think J.P. Morgan today went to 40%. So I think economists universally agree that tariff turmoil is increasing the odds of a recession. Actual tariffs would probably push the U.S. economy and maybe even the global economy into recession. So everybody's hoping that there'll be a lot of negotiations that keep this from happening.
You're speaking about something super interesting, right? Because inflation is slowing down. So then what's driving that trend now?
Yeah, well, if it wasn't for Trump 2.0's focus on tariffs and using a shotgun to reduce the headcount in the federal government, I think the economy would be fine and the stock market would be fine. It's a pity that the administration felt that they had to do so much in such a short period of time and destabilize an economy that's doing quite well. The labor market indicators are looking quite good. Consumers have been spending, but we're clearly going to have a risk that the consumers will cut back if they start to figure that the stock market, instead of giving them a positive wealth effect, is giving them a negative wealth effect.
Edward, I'd like to dig deeper on this. Which sectors of the economy do you think are performing well? Which could be struggling? How do you see that?
Well, for the past 3 years, there have been a lot of concerns that the tightening of monetary policy would cause the consumer to retrench, and that once the consumer ran out of excess savings built up during the pandemic, that would surely lead them to cut back on their spending. And none of that happened because the labor market continued to create jobs. Wages started to rise faster than prices. And there's been evidence that productivity is actually picking up. So the consumer really is the key to the economy. And I think that's where we could have some weakness. Some of the strength in the consumer spending have been retiring baby boomers who have a tremendous amount of wealth, retirement wealth, and they're spending that wealth. But if instead of seeing their stock portfolios going up, they see the stock portfolios going down, that could obviously weaken the consumer. Technology has been a very, very strong sector. I think it remains strong. But with the concerns about what DeepSeek implies in terms of AI, do we really need to spend all that money on AI? Might it be commoditized and turn out to be a great technology that nobody makes any money with? And those are some real possibilities. The housing market is obviously weak, but now with mortgage rates coming down, there could be some lifting of that. But clearly, a lot of the tariff goals of this administration is to get more onshoring. And under Biden, there was already efforts being made to onshore technology companies. And now we'll see if that picks up. It won't pick up if the global economy is weakened by a tariff war.
Edward, the Federal Reserve meets next week. How do you see interest rate cuts going forward?
Well, the Fed's kind of boxed in. The Fed does tend to be dovish. It's been indicating in its language that the next move will be to lower rates. But they also have been saying that they're in no hurry, there's no rush to lower rates because right now the economy looks okay, given that the unemployment rate is 4.1%. The inflation rate today obviously should encourage them to consider lowering interest rates sooner rather than later. However, they, like everybody else, fear that once the tariffs start kicking in, we're going to have at least one-shot increases in price indexes, and the fear is that that could become more than a one-shot development.
And what should international businesses and investors watch for in the coming months?
Well, I think a lot of international investors, global investors, have already made a decision to cut back on their U.S. portfolios and to spend more on European portfolios, Chinese portfolios, mostly because those are the valuation multiples are lower. The stocks are cheaper in China, they're cheaper in Europe, and now there's signs that the Europeans are going to stimulate their economy more, especially in the area of defense. So you got cheap stocks where the market's starting to anticipate that there might be better than expected growth. China is a little bit more controversial because obviously the government would like more growth, and the government has reached out to entrepreneurs to get them to do what they do best, and that's innovate and create productivity and improve prosperity. But the underlying issue is consumer spending. And consumer spending, I think the government would like to stimulate it and will do what it can. But of course, there's the demographic profile where people are getting older, and older people don't spend as much as younger people with families, for example.
Thank you, Edward Yardeni. Great having you.
Thank you.